What's up, guys? Jeremy Warden here, co-founder of BNBCalc, and I'm going to tell you today about a special tax loophole called the short-term rental loophole that not many real estate investors actually know about. The ones who do know about it, the ones who are leveraging it, are saving thousands, tens of thousands, and in many instances, hundreds of thousands of dollars on their tax bill. So BNBCalc just built out a special tool to help you visualize potential tax savings. I'm going to dive into it. I'm going to show you an example. You're going to want to stay tuned until the end because I'm going to show you exactly how it works, kind of what the variables are, and things you should be thoughtful of in order to leverage the short-term rental loophole. So I'm going to get into it. First thing I'm going to do is I have the BNBCalc up on my screen. Going to make myself smaller here and go to Zillow just to find a property. Just pretty random. I don't know. This one, let's just say like just call it a $345,000 property. You know, looks solid. Can be an Airbnb. Definitely would want to do some stuff to this backyard here, but let's just not even relevant. Let's just take this share link, paste it from Zillow, have it populate relevant information. Looks like it's a 3-2. There might be a way to make it 4 bedrooms, but I'm just going to even ignore that. Let's assume it can sleep like 8 people. Again, for the takes of this tax calculator, that might not even be important, but whatever. We're going to run this in here again. Haven't actually looked at this property from a profit standpoint, but what I'm looking at it right now, I want to show you guys is this tax savings standpoint. So again, looking up here, potentially the property might have a negative cash flow based off these quick projections. You might need, if you're going to do a second home loan with 10% down, you might need about $60,000 in cash. But what I'm gonna tell you guys about is that 60 grand. How much can that $60,000 save you on your tax bill? So let's do this. We're gonna go into the estimated tax savings section. First of all, we have an article here that's talks about short-term rental tax strategies. I'm not an accountant, so this is just my experience. I definitely recommend you talk to an accountant before making any investments and getting their legal opinion on stuff. However, so standard normal depreciation. So how it normally works when you buy a short-term rental and you don't, do a cost segregation or any of the stuff I'm going to talk about today, you can write off over a 39-year period. You can't write off the entire purchase price of the property. You can write off the structure value. The IRS doesn't let you write off the land, but what they do is they say that the structure itself is going to lose value every year. Does it actually lose value? Not necessarily, but they allow you to write it off as if it's losing value each year. So standard depreciation for a short-term rental, normally it's 26 and a half years for a rental property, but a short-term rental, many accountants, believe it's under a 39-year period. I don't need to get into the minutia of why they think it's 39. It's something about being like a commercial something property. Again, not an accountant, but the ones I work with tell me 39 years. So that means if we're just going to take this, and again, we're talking about standard depreciation because I want to show you how crazy a short-term rental loophole and the bonus depreciation will be. So from a standard perspective, we're going to just, first of all, what we want to do is go down here and just look at the structure value. So the purchase price again was $345. The structure value is 70% of that. How does BNBCalc get that? It's actually calculated from MLS data. What essentially BNBCalc does is it looks at that structure tax value relative to that structure plus land tax value. So here it's saying that the structure, according to the tax values, is 0.7 of the entire value of the structure and land. So what we do is we take that 70% of that 345, come up with this 240,000 in structure value. We assume that you can accelerate 30% of the structure value. Again, I got this from an accountant. This is, the assumption that I personally use, but this is an assumption. So, it could be 25. Essentially, what you do with the accelerated depreciation component is you do a cost segregation study. So again, when I showed you guys earlier, Standard depreciation is a 39-year schedule. However, if you do a cost segregation, you can change the speed of the depreciable items. So instead of just being a 139-year structure or house, it's going to instead be, the windows, the paints, the floors, the appliances, like all the little line items. And a lot of them, appliances, for example, can be 5-year schedules. So when you do this cost segregation study, what you find a lot of times is about 30% of that structure, instead of being on a 39-year schedule, can actually be on a 5-year schedule. In addition, if you've put in furniture, that's something that can be included in a 5-year schedule. So what you get is an accelerated depreciation. So again, amount you can write off over a 5-year schedule. What I'm going to get into in a second is how you can even speed it up beyond that. So we have this 5-year, 84 grand is on a 5-year schedule. Right now, per, I think it's like one of the Trump/COVID tax relief bills, you can apply an 80% bonus depreciation on that 84,000. So what's normally on a 5-year schedule, you can take 80% of that in year one. Next year, it'll be 60. The following year, it'll be 40. Then it'll be 20. And then eventually it's going to sunset potentially. Or, they could extend it. I'm not a lawyer, not an accountant, or a politician. So we'll see. But essentially, we're taking, at least in this year, 2023, we're taking 80% of that 84,000, and we're going to take it as bonus depreciation in year one. Again, we still have some leftover accelerated depreciation. We only took 80% of that, what's on that 5-year schedule. So there's still some of that left. And there's also leftover standard depreciation, things that were on a 39-year schedule. So we're showing 67,000 in bonus depreciation year one, assuming, we're at a 30% tax rate. That could be, and then we also have the other, again, there's more than just even that, again, this property is showing a loss, for example, like based off the initial calculation. We didn't really dive too much into that, but, we're showing a tax deduction from a loss of 113,000, and that includes this bonus depreciation. And of that, 30% is a $34,000 income tax savings. Again, we spent like 50 grand here to save 34,000 on our taxes. The more and more expensive of a house you get, the more and more prominent this bonus depreciation is. So if you're buying like $1 million house, it might be a couple $100,000 in bonus depreciation, which is absolutely nuts. If you already own the house, you might want to look into doing this as well. If you've already taken some depreciation, that gets factored in. But yeah, guys, I hope you guys appreciated that demo. So what we just did is we took something that we would be able to show a standard depreciation of $6,000 off in year one. So a $6,000 phantom loss. And we just turned it into a $67,000 bonus depreciation, in addition to a $4,000 standard depreciation, as well as this $1,681 accelerated depreciation. So pretty crazy, pretty powerful. You might be able to tell why a lot of folk are doing this now. So I hope you guys like this tool we built. If you guys appreciate, this tool, we built it, it's the same. We did it complimentary to BNBCalc subscription, so it wasn't an add-on cost or anything like that. We just knew it'd be a really helpful, powerful tool. So if you guys appreciate this, please like this video, please comment, please share it with a friend. And as always, happy hunting. I hope you guys are crushing it. And hope you guys like our tool.